Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, this is always one of my favorites shows, the Friday show, because it means the weekend's tomorrow. And in all honesty, I actually like Fridays almost more than Saturdays. It's like a psychological thing where you're like, oh, usually you got a little less work sometimes. And then, Saturday, you're like, oh no, tomorrow's Sunday, and then we're back at the grind. So some about Friday night is just very magical. But welcome, everyone, to the Friday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I'm sick, on vacation, or it's the Azalea Festival. And it is neither of those things, so away we go. Where do we start? Iran war? Let's start there. All right, so rates were up slightly. Not even, let's see, were they up 3 basis points? Yeah, a little bit over. 10-year is up about 3 basis points, which is my metric. So if you've heard me on my website, wilmington-mortgage.com, I have a little rate tracker for the day. And anything less than 3 basis points in a move, up or down, is neutral, no change. 3 basis points is my move that puts it in a new category, either good or not good. And then over 10 basis points, so getting to double digits, you then go from great to bad. So it just was enough to eclipse to the not good category on my meter. So, 3 basis points increase. But, I think we were down, 6 or 7 yesterday. So still good, at least averaging the last 2 days. And then Mortgage News Daily had rates unchanged for the day. So holding at 6.44%. One of the reasons why was, even though we got some great news about Iran and a possible maybe negotiation, agreement, ceasefire, peace deal, whatever it is, we have yet to hear from Iran, at least by Thursday evening. We have not heard anything. New York Times reporting that Iranian officials said on Thursday that their country is discussing with the United States a one-page proposal to reopen the Strait of Hormuz and end hostilities for 30 days while they try to reach a comprehensive peace settlement. So we have not heard from Iran about future talks that could lead to a longer-term deal. The plan has 3 main points, according to 3 senior Iranian officials: lifting of the U.S. blockade on Iranian ships and ports, the opening of the strait to commercial traffic, and the ending or an end to the fighting. The key stumbling block preventing the initial agreement is what to do about Iran's nuclear enrichment program and its stockpile of highly enriched uranium. The U.S. wants Iran to agree in principle to hand over its entire stockpile and suspend its enrichment program for 20 years. Iran instead has proposed diluting some of the uranium, sending the rest to a third country, possibly Russia. Oh, that's good. And suspending its program for a shorter time, 10 to 15 years. Which, the biggest problem that you're going to have is that it's like you're taking Iran at its word, which we know every time we've had an agreement with Iran, they don't abide by it. It's why we're in the situation that we're in now. So that's the bigger problem, is that if we go, okay, we're going to make an agreement, how do we make sure they're holding up their end of the agreement? Like, how do you trust a country that tends to lie? It's not going to be easy. But because we do not have anything concrete or any real forward momentum, not surprisingly, you're going to see a slight pullback from what we saw yesterday. So it's not all of that surprising that the fact that we have not had a development with regards to Iran is why we did see a little bit of an increase in bond yields. So a little bit pullback in mortgage rates. But we did get some good data with regards to inflation. We also got jobless claims. We'll get into that in a second. And then recession fears. We'll talk about that. So short-term inflation. So we got the New York Fed. I think it's the New York Fed. Yeah. They do a survey about consumer inflation expectations. And while we did see an increase, which of course is not good, it's the longer term outlook that really matters, which we did not see a change. So the latest survey showed median inflation expectations rose to 3.6%. Not great. We were at 3.4% in March. So we're now back at the highest level since last April, when, of course, we had the Liberation Day, Trump's tariffs, and it popped up inflation because of that. Expectations further out, though, 3-year and 5-year ahead, we're at 3.1 and 3% respectively. Now, this is important. This is the much bigger part of this report. So we saw the jump in the short term. We don't like that. It's not good. But the reason why it is good, the full report, is the long-term 3 to 5 year has not changed at all. Because if we go back to the start of the Iran conflict, now outgoing Fed Chair Jerome Powell said near the start of the conflict, remember, I think he was talking with, was it Harvard students? Harvard or Columbia? I think it was Harvard. And he said inflation expectations do appear to be well anchored beyond the short term. And if you remember, he was being asked about, is there going to be a change to monetary policy with regards to this conflict? And he said, well, first of all, monetary policy takes a while to work its way through the economy. So short-term supply shocks, because of what is going on, which, with oil, by the time the impacts of the monetary policy were felt, the shocks could be over. And so then you would have a problematic situation, because now the economy is reacting to an event that's no longer taking place. It's not sort of a systematic, sort of fundamental issue. It's a shock. It's a shock to the system. And monetary policy is not well suited to deal with that. But he did make it very clear that if this shock continues and sort of starts working its way through the economy, so all of a sudden the jump in energy prices become entrenched, then you have an issue where then people expect it. And then companies are like, all right, well, we've been paying these higher energy prices now for a while. We're going to have to start putting those into our prices. We're going to have to start raising our prices to pay for this new normal, which is these higher energy costs. And then they got a problem. Now we have an inflationary issue. And now the Fed will have to act. And so the good news is we're not seeing that. There's still no change to 3-year, 5-year expectations. So the Fed is not going to be under pressure to do something. So yes, it's awful that the short term popped, but the fact that we're still seeing no movement in the mid to long term, that's good news. That's very good news. Also in the report, consumers appear less worried about energy prices spiraling higher, as we're seeing in the short to midterm, or mid to long term. Year ahead gas price expectations dropped sharply, 4.3 percentage points to 5.1%. Food inflation expectations also eased. Home price growth expectations did decline as well, down to 3%, down 0.3 percentage points from March. So people aren't feeling super confident they're going to see a lot of appreciation in their homes, which is probably not a horrible prediction. However, there is a concern. Consumers still think prices will rise faster than incomes because of the short-term disruptions. Expected household income growth slipped to 2.8%, while spending growth jumped to 5.4%, the highest level since July 23. So they're thinking they're going to be spending 5.5% more, but they're only going to be seeing an increase of less than 3% on their income. So their costs are going to rise faster than their incomes, which is never a good situation, which can be sort of a recession indicator, because if we do see consumer spending pull back, that's 2/3 of our economy's consumption. So they pull back, it's kind of a big deal. And that's precisely what Whirlpool is seeing. So Whirlpool was out this morning arguing that it is seeing recession-level declines in the industry. This according to the Wall Street Journal. And because of it, they're going to see higher appliance costs. The Michigan-based maker of refrigerators and washing machines said Wednesday that it would suspend its dividend as it focuses on paying down debt. The company also cut its full-year earnings guidance roughly in half, from $6 a share to a range of $3 and $3.50. Stock, of course, fell as in reaction to that by about 20%. So big time drop. Chief Financial Officer Roxanne Warner said U.S. consumer confidence nosedived to historically low levels, driven by higher costs because of the war, and the anemic housing market has not made anything better. Though shoppers are replacing aging or broken appliances with modestly priced equivalents, they are shielding away or shied away. Not shielding. They're not being shielded away. They shied away from the company's higher prices, which are more profitable for the company. Warner said the company was further hurt by the Supreme Court's decision to invalidate the Trump administration's emergency tariffs. A lot of their competitors lowered prices expecting rebates. And then they said that they are expecting a benefit from the new tariffs that have been announced by the administration, especially a 25% levy on the total value of imported appliances. And this is why I don't like tariffs, because they're like, oh yeah, we're really struggling to compete. They make all their products here. And so, that's sort of the nationalistic populist argument, right? That they make their washing machines here. They employ people in America. So we should protect that industry. But clearly what we're hearing from Whirlpool is they can't compete with a lot of these foreign competitors, at least at the lower price points. And so they're like, oh man, thank goodness these tariffs are going to get put into place. And so that's going to help their earnings and everything else. So they're going to make more money, but it's going to cost the consumer more. And so, it doesn't sound very good for the consumer, which we're already worried about consumer spending. And it's not like they're like, oh, this will be great. Now, if you notice, it's good for Whirlpool. It's not good for consumers. And so that's one of the reasons why I don't like tariffs. But it does show that, the consumers are feeling it. No doubt about that. Hasn't shown up in the data, but if this continues, it could. No doubt. All right, it is Jobs Week, so we do have our second to last report. We got non-farm payroll coming out tomorrow. Second to last report was jobless claims, the weekly report that we get. If you remember last week, jobless claims fell to a 57. Wait, was it 57? Yeah, 57-year low. We got all these layoff announcements and everything, and we got Fed governors worried about the labor market, and jobless claims 57-year low. There we go. We had claims rising this week, not surprisingly. I assumed they weren't going to fall after hitting the 57-year low. Can I say it again? 200,000 is where they were, increase of about 10,000. Despite the weekly increase, claims remain near historic lows, not surprisingly. Continuing claims also fell, declining by 10,000. So we saw an increase of 10,000 on jobless claims, 10,000 decrease on continuing claims to 1.766 million. That is the lowest level since April 2024. So we're at basically a 2-year low for continuing claims and a 57-year low for jobless claims. Labor market seems to be doing okay. According to the data. Now, people are going to say, Tyler, it's not great. I'm saying according to the labor market's official reports, things look okay. We had private payrolls jump this week. I guess we'll find out tomorrow with non-farm payroll. And unless that report is just crazy good or bad, with the focus still being on Iran, it's unlikely to move rates. But we will see. But that is it. We are done. You guys enjoy your Friday. Enjoy your weekend. We'll be back here. Well, I don't have a Cape Fear report. So maybe I'll do a show on Sunday or something. Maybe I'll be back Monday. We'll see what the data looks like. But you guys enjoy your Friday, enjoy your weekend. We'll be back here maybe Monday, maybe Tuesday, with another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.